Hello, everyone. Thanks for joining us today for the Money Show Mid-Year Portfolio Review. I'm excited to introduce you to David Russell, Director of Marketing and Communications at Goldcore. Mr. Russell is a former professional trader who started his career in financial markets in 1997. Having experienced trading during the dot-com collapse post 9/11 and the global financial crisis, he became interested in the benefits of owning gold as part of a balanced portfolio. The chat is open in case any of our audience members have questions, which we'll address towards the end of the presentation. We'll actually have in the booth question and answer time. So I'm sure everybody's eager to get started. So without further delay, I'll leave you in the capable hands of our speaker, and we'll be here in case you need anything. David, the floor is yours.
Super. Thank you very much. Good morning, everybody. Now, we all know that economic storm clouds are gathering, and just two days ago, the famous hedge fund manager, Ray Dalio, he wrote an article in Time magazine. That article was titled, "Why the World is on the Brink of Great Disorder." Now, we don't know how bad things are going to get. And as a result, smart investors are concerned about how dramatic negative changes in the economy can impact their portfolio and how they can protect themselves. And you're right to be concerned, because the reality is that most portfolios are not positioned for the coming economic storm. They're still positioned for exponential growth. They contain fragile assets that don't do well during storms, assets that depend on the continued performance of others, assets that depend on the continued printing of money. However, there's an opportunity to act now by having an appropriate allocation to gold in your portfolio, because gold is an anti-fragile asset. It's 5,000 years of history of weathering economic fragility. It stands in the face of economic storms. However, not all gold investments are the same, and not all of them are suitable for your portfolio. So understanding what I'm going to talk to you about today will make you more successful when you invest in gold. So we're talking about the 5 steps to protect your portfolio from the coming financial storm. And these are the 5 things that we are going to discuss today. So the very first thing is understanding the role of gold in your portfolio, the anti-fragile asset. What do we mean? What do we mean when we say it's an anti-fragile asset? Well, the first thing that gold is well known for is as an inflation hedge. Here's a bit of research that was done by Bloomberg. It looks at gold's performance during times of low inflation and times of high inflation. It performs well during times of low inflation, but it particularly performs well during times of high inflation. We can have a look there. We see it in nominal terms and in actual real returns, which is nominal returns less inflation over those periods of time. It's a store of value. What do we mean when something is a store of value? Well, there's a video that's in the booth that you can watch, and it's a video that was made a good number of years ago by us. It was quite a successful video. There's a couple 100,000 views on it, which was large at the time. However, one of the things that we looked at to understand the concept of a store of value is, we said 100 years ago, how much gold or how much bread could you buy with an ounce of gold? And we broke it down in a visual context. There was visually immediate there. I think it's about 100 loaves of bread there. And we look, how much will an ounce of gold buy you today? Now there's 548, I think it is, loaves there. I counted them. And I guess that this was done a couple of years ago. That's actually now gone up. So an ounce of gold will buy you about 750 loaves of bread. So that's what we mean when it's a store of value. Not only will it buy you as much as it used to, it actually will buy you more. And if we look over the same period of time, what's happened to the dollar? The US dollar has lost 97% of its value. What it means by that, 97% of its purchasing power. And again, if we use the same analogy of bread, 100 years ago, you'd have bought 10 loaves of bread for $1. Today, half a loaf or at the time of making, this was half a loaf. That's actually gone down. You can probably knock another 2 slices off that. And it's not just the dollar. We can see that over time, gold has outperformed all major fiat currencies. So we can see performance there against the dollar, against the euro, against pound sterling, against yen. But we can also see its performance against currencies that are no longer here. The Reichsmark, the Deutschmark. It holds its value. That's what's one of the things that makes it an anti-fragile asset. Another thing that makes it an anti-fragile asset is that it is no one else's liability. It does not depend on anyone else for its performance. And if we look at what we normally hold in our portfolios, equities depend upon the performance of CEOs. They depend on the performance of the board, the management, the decisions that they make. If we look at the bond markets are dependent upon the performance of politicians and their ability to continue to raise taxes and continue to manage an economy to such an extent that they can continue to raise more and more taxes as we see increases in debt in order to service that debt. And when we see continued growth in debt, that is actually saying that we expect that the future is going to be better than today, and that we are going to be able to continue to grow and continue to fund larger and larger debts. And we're growing exponentially in that regard, which means that there's an expectation that the future will be exponentially better than it is today. Property, another thing that is held generally in a portfolio, depends upon the performance of a number of contributing factors. So performance of the ability of tenants to continue to be able to afford to pay their rent. It depends on the ability to continue to manage that property and all that comes with it. And then if we look at cash, cash is dependent upon the ability of central bankers to continue to manage the currency. And what have we seen over the last number of years is exponential growth in money printing. Another thing that makes gold an anti-fragile asset is its tangible nature. What do I mean by that? Well, we can only increase the amount of gold that is above ground at the rate at which we can find it, mine it, and refine it. It is limited in supply, and it's limited in supply by nature. It's not limited in supply like cash is by the whims and wit of central bankers. As a result of it being an anti-fragile asset, it has the effect on the portfolio of smoothing and protecting. So protecting returns and smoothing volatility. We can see over the last number of crises how gold, which is the right-hand column in each one of these, has performed. So whether it's post 9/11, the global financial crisis, the sovereign debt crisis, Brexit, or even through COVID-19, you can see that gold performs and outperforms these other asset classes during those times because it is the anti-fragile asset in your portfolio. And that's why people buy it, why people invest in it. You can see here in this research by the World Gold Council that the vast majority of people that invest in gold invest in it because of its diversification qualities and its natural inflation hedge. As we like to say, gold is not a financial investment in your portfolio. It's essential financial insurance for your portfolio. And if we look at what's going on with central banks and their relationship with gold, we've seen this year and last year, for the last number of years, absolutely huge amounts of borrowing buying, by central banks of gold. If we compare that to previous years, we are at an all-time high last year in the annual purchases by central banks of gold. And they purchase it for exactly the same reason, because it is an anti-fragile asset in their portfolio. So once we understand that it is that anti-fragile asset that we need in our portfolio, the next thing that we want to do is decide what it is that we want to invest in. Gold investment products come in many shapes and sizes. There's different ways to look at and navigate those options, but we've looked at those four now. Is it an inflation hedge? Is it a store of value? Is it no one else's liability? Is it tangible? And does it reduce volatility? And if we look at what would be considered the four most popular categories of gold investment products, gold ETFs, gold futures, mining stocks, and then physical gold bullion, we can see how they rate against each other. Ultimately, because they are all gold products, they perform well as an inflation hedge. As a store of value, physical bullion and bullion held in a gold ETF are very good stores of value. Gold futures, because by their nature what they are is they're a derivative contract, are not a great store of value. And neither are mining stocks, because mining stocks are exposed to an awful lot of the same equity risks that traditional equities are. So they are dependent upon the performance of the management team. They're dependent upon their performance and their ability, again, to find it, mine it, and refine it. So while they are a good speculative bet, they are not generally considered a good store of value. And one of the proofs of that is that we're seeing at the moment is that as we saw gold, physical gold, an ounce of gold go to all new time highs, we hadn't seen a corresponding similar strong rally in the mining stocks. In terms of being nobody else's liability, all of them fall short except for physical gold in that regard. Gold ETFs have layers and layers of custodians, sub-custodians, managers, and so on and so forth that create layers of liability within that. Gold futures are by their nature, because they're a derivative contract and somebody on the other side and an exchange in the middle, are indeed somebody else's liability. And mining stocks, because they fall into the general equity risks, are also considered somebody else's liability. But physical gold that you hold or that you store is nobody else's liability. You have it there in your hand, physically tangible, able to touch it. And that's another thing. It's the only one that is considered truly tangible. As a result, there's really only two gold ETFs and gold bullion that do a good job of reducing volatility. And as a result of that, it's physical gold in the form of coins and bars that really stands out when it comes to being an anti-fragile asset in your portfolio. But then if we talk about coins and bars, if we go down one more level, I say, well, what should we buy? Should we buy coins or should we buy bars or should we both? Well, this is a real horses for courses type of situation. There's a number of key distinctions and differentiations between the two of them. The first one is premiums. Premiums is the cost over and above the spot price of gold, which covers all of the costs involved in taking a gold bar, gold ingot, and converting it into an investment grade gold product. So it covers the minting, the marketing, and, well, a small charge for your dealer so he can make a bit of money. When it comes to premiums, you will find that the larger a gold product is, the smaller the premium tends to be on it. And the reason being is that it takes about the same, it costs about the same to mint or to press or to cast 10-ounce gold bar as it does a 1-ounce coin or bar. But the reality is that as a percentage of the total value of that bar, that means that it's a lot smaller. So if you have a 1 kilogram bar, which is about 32 ounces, and it costs a similar amount to physically make that product as it does a 1 ounce bar, well, then the cost as a percentage value of that bar will be a lot smaller than it will be for the 1 ounce bar. Divisibility is something that is key. If you had 20,000, I'm going to use round numbers on this. If you had 20,000 to invest in, you have two options. You could buy one 10 ounce gold bar, roughly, or you could buy 10 1 ounce coins. If you bought a 10 ounce gold bar, you'll benefit from lower premiums. So it'd be slightly cheaper to buy. However, if you come to a stage where you decide you want to liquidate, you only have a choice of selling the entire bar. You couldn't sell off a fraction of that bar. So while you get the benefit of lower premiums when you buy larger bars, you don't have the benefit of divisibility. So if you bought 10 1 ounce coins or 10 1 ounce bars for a similar price, you're able to sell off a fraction of that at a time. So we might come to the decision that the price of gold has gone up. It's appreciated by 10%. So you want to lock in a little bit of value on that. So you can sell one coin or one bar. That's not afforded to you by buying a 10 ounce bar. So divisibility is key. I use a 10 ounce bar there as an example, but if you're buying $60,000, $70,000 worth, that might be a kilo bar, then the problem becomes exponentially larger. However, if you're investing 100,000, 200,000, 300,000, 400,000, and your motivation is to keep your costs low, and your motivation is to have it in your portfolio as this anti-fragile asset, then that might be an option for you in that situation. Storage is a key consideration as well when you're buying. If you're going to invest in gold and whatever amount that you want to invest in, and you decide that it's going to be stored on your behalf, what those products look like, and what I mean by that is coins are far more attractive than bars. But that's really only a benefit that comes from holding them in your hand. So if you decide you want to buy 10 1 ounce coins or 100 1 ounce coins, and you want to store them at home because you have the facility to do that, coins is a much more pleasurable way to do that. Whereas if you're going to buy these and have them stored on your behalf, and you're never going to see these bars, well, then something that's probably less attractive, like a bar that you see in the picture there, might be more economic way of achieving that end. When you decide what to invest in, it's also important to understand what not to invest in. And when I'm talking about this, I'm not saying never invest in these products. I'm saying if we're looking at gold as that anti-fragile asset that we want to have in our portfolio, because we want to have a hedge against inflation, a store of value, and we want it to smooth out the returns and protect and dampen the volatility in our portfolio. There are ways to go about it, and there are ways to avoid. And certain things that are not necessarily the most efficient way to invest and achieve this would be something like numismatics. These would be highly collectible coins and bars, but mostly coins, whose values derive mostly from the premium over the gold price than the gold price. So therefore, the fluctuation in the gold price is not necessarily the main driver of the value of these coins. So if we're looking for something that's to perform as an anti-fragile asset, numismatic gold coins are not the easiest thing to invest in. They require that you have a fairly good understanding of the numismatic market and the value to ensure that you are maximizing your potential returns. Semi-numismatics fall into the same category. These are collectible. These are collectible coins. They don't tend to have a value as great over the spot price of gold as numismatic coins. They tend to be more modern coins. They tend to be coins that are issued for special occasions. They tend to be low coins or rounds of low mintage. What you generally find is that a lot of the value in that is in the premium, is in the scarcity, the low mintage. They don't necessarily track the gold price as closely as investment grade gold bullion. So again, while they may be nice to have, nice to hold, nice to invest in, and if you have a lot of time and it's your hobby, a very interesting hobby. I collect a lot of coins myself, a very interesting hobby, but it's not it's not the thing for the first time investor. Let's put it that way. Collectibles fall into the same category. What we're looking for here is things with a very strong origin in them. So when we're advising investors, what we tell them to look for is coins or bars that are produced by government mints or LBMA approved refineries. Because when you do that, what you know that you are investing in is you're investing in highly liquid products, because that's what is key in this. Because you want to ensure and you want to know that on day one, that whatever it is that you're buying, there's a market for you to get out of that product on the far end when you decide that it is time for you to sell. So that is key. We make a two-way market. It's just make a two-way market in all products that we sell, and we tend to limit our products to exactly that, to products from government mints and products from LBMA approved refineries, because they are the most liquid, and liquidity here is key. Now, I've talked briefly there about storage. There's two options when it comes to storage. One is that you can store it at home, and if you have a small amount that you are gold coins, 10 ounce gold coins is not going to take up a huge amount of room. And if you are willing to take those and store them at home in a safe, secure place in a vault or a small safe, if you have that, that's entirely your prerogative, ensuring that you have adequate insurance in that. You leave yourself obviously open to risks of being visited by people that you don't want to. But another way to store your gold is to have it stored on your behalf, stored in a professional, specialized precious metals vault. And when that happens, there's a number of ways, and that a number of things that you need to look out for. And one of those things is that gold is stored on your behalf in what we call a fully allocated way. That means that there are specific coins and bars effectively with your name on it in a separate account. That you are able to, that you have a ownership of a whole holding of gold and not part of a larger holding. So what I mean by that is there's many gold products out there, and effectively what investors buy is they buy what's called unallocated gold. And what that means is that there might be a 400 ounce gold bar, and you have a claim. If you've bought 10 ounces, you have a claim on 10 ounces. You own 10 ounces of that 400 ounce gold bar. And the rest of that 400 ounce gold bar is owned by other investors. And I don't have to point out to you the difficulties that there are if you're unable to take delivery of something like that. It has to always be stored on your behalf. It's always effectively commingled with other investors. When something's fully allocated, that means that if you own 10 ounces of gold, it's in a format that's 10 1 ounce bars, 1 10 ounce bars, 10 coins, or whatever. It is fully allocated, and if required, you can take delivery. You can request that your gold is shipped to you without any further costs of converting it into a physical format. The next most important thing is that it's fully segregated. And what that means, as it suggests, is that it's separated out from other investors' gold. So it is sitting there. Your 10 1 ounce bars are sitting there on a shelf, separate to other investors. Not commingled with other investors, separate to other investors. Another thing that is really important is, well, you can't just take the word of the person that is storing it on your behalf. They need to be independently audited and independently verified. That means that it's important that a third party comes in and says, yes, we can see that on your behalf, sitting on that shelf, there are 10 1 ounce gold bars as you understand them to be. and they are genuine gold bars. Why would you have it any other way? We do this and we offer this across a very large network. And the reason that we're kind of unique in this way, because it's, as you can imagine, it's more difficult, more time consuming, more cumbersome offering a fully allocated and fully segregated offering like this. We've been doing this for a while, and we're doing it to such a scale, and we have developed our systems that we're actually able to offer this at the similar price to what other people are offering unallocated, non-segregated gold at. And we do this across multiple locations, both in the US and in Europe, Switzerland, London, Dublin, and also in Asia. And we only use professional, specialist precious metals vaults. So this is not something that is stored in a safe in our office. So the fifth and probably sometimes the most important decision that you can make after you have decided to ensure that you have an anti-fragile asset like gold in your portfolios, how much should you invest? And this is a question that we get asked all the time. And the answer is generally it depends. There's an old Wall Street saying that says, put 10% of your money into gold and hope that it doesn't work. What that suggests, and it speaks to the anti-fragile nature of it, is if gold is not performing, it generally means that all the rest of your portfolio is. But if gold is performing, it generally means that the rest of your portfolio isn't. But there was that 10% rule of thumb. And 10% is generally a good place to start. If you're starting off and looking at gold for the first time and you're just becoming slightly nervous about the economic storm clouds on the horizon and seeing how things have the potential to unravel, 10% is a good rule of thumb. It's a good place to start. Now, if you're more concerned, you might want to increase that allocation. Maybe you want to have 15, 20%. There are some people that it depends upon their outlook and their view of the world. I interviewed Rick Rule, who's the ex-CEO of Sprott Asset Management. And he said that gold helps him sleep at night. But what he said as well is that having gold in his portfolio has allowed him to take greater risks with the rest of his portfolio. So that's something to sit and to think and to ponder on, which is how much risk are you taking with the rest of your portfolio? If you've got quite a high degree of risk in your portfolio, you might want to increase your allocation above 10%. But in terms of adding a percentage to your portfolio, this study was done on US pension funds, a hypothetical average portfolio over the last 20 years. And just as an aside here, you can and we can facilitate purchasing gold through pensions through an IRA. That's something that we do. But this is a nice piece of research that was done, and it shows the benefit over the previous 20 years of an average portfolio of adding between 2.5%, 5% and 10% to your portfolio, and how that played out for the risk-adjusted returns. And you can see there that an allocation of 10% significantly increased the risk-adjusted returns of the average portfolio. So again, that speaks to the idea of the anti-fragile asset nature of gold, the performance of gold over the years, and the benefits of having it as having an appropriate allocation within your portfolio. Now, if you're actually purchasing gold, so they're all the decisions that you make. But how easy is it to actually invest in gold? It's quite simple if you're using a company like Goldcore. You open an account. It's a simple online procedure. You deposit funds, And then you can speak to one of our advisors, or even do it online, make a purchase, and then just decide if you're going to take delivery of that or if you're going to store it. It's a simple process. There's nothing complicated about it. The biggest and most important and most difficult decisions are: do I need an anti-fragile asset in my portfolio? That's step one. Understanding why it is that we invest in gold, and then trying to find what's the most appropriate way for me as an investor putting that anti-fragile asset into my portfolio to do it. So who are we? Well, we're celebrating 20 years in business this year. We've seen the good times, we've seen the bad times. We've got clients, over 15,000 clients, and we have done over $1 billion worth of precious metals sales. Now, I say precious metals, we are heavily involved in both gold and silver, and a lot of what I have spoken about here also applies to silver. We are an affiliate member of the LBMA, the London Bullion Market Association. We are one of only a handful of bullion dealers across the globe that is a member of the LBMA. We operate one of the largest storage networks in the industry. We have partners, as I say, across the US, Europe, and Asia, in all the major centers. In terms of servicing our customers, Ecomi is the rating that we are very proud of. We have a rating of 4.9 out of 5, and that's from thousands of customers at this stage. Member of the Better Business Bureau. And we have clients in over 75 countries around the globe. And we're around 20 years, and we've been seen in plenty of places. So we've been seen on CNBC, BBC, CNN, Reuters, Bloomberg, to name but a few. Now, there's a small report that everybody can get access to, which speaks to a lot of what it is that I've talked about, but particularly a checklist for people who are interested in purchasing gold. And it's called the Gold Buyers 5-point checklist, and you can download it. You can download it from the URL. I think the URL is probably in the booth here, but if it's not, it's very simple to remember. It's Gold in the USA. And I'm joined on this call actually by two of my colleagues, Derek Ryan and Matt Zaras. Matt actually runs our California office, so it would probably be a major point of contact for anybody on this call. And I highly recommend that you can reach out to Matt at our offices. The details are available on the website, or join Matt and myself and Derek either after this. We'll have a few questions and answers now for the next couple of minutes here at the end here, but there's also another Zoom call that is set up, and Matt and Derek and myself will be on that immediately after this for anybody who has any further questions arising out of this presentation. But the overriding thought that I really want everybody to be left with, because there are economic storm clouds on the horizon, and it is important that there are anti-fragile assets in your portfolio. And the best one of those really is gold. So as I always say, and we always say here, is that gold is not a financial investment in your portfolio. Gold is essential financial insurance for your portfolio.
Great. Thank you so much, Dave. We appreciate your presentation, and thank you to our audience for joining us. We have more speakers coming up, so stay tuned for more. Great. Thanks again, Dave. Appreciate it.
Thank you.